Happy Wednesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Wednesday, October 4th, 2023. We'll start with our executive summary. So, number one, reflation and inflation are now tied for top down market regime status. Obviously, how that resolves itself, that tie in the coming weeks or coming week or so, in our opinion, it'll be very important as it relates to your general investment bias, your factor leans, and your disposition towards asset markets. If you want to understand the difference between reflation and inflation from a top-down market regime perspective, obviously you need to become a 42 macro client to get that information. And for those of you who are current clients, we obviously appreciate you. You know well aware what that means. So we'll keep it moving. Number two, we were of the view that 4.75% was a reasonable estimate for the high in the nominal 10-year treasury yield in this market cycle in the absence of further BOJ tightening this fall. 5% was our number with more BOJ tightening. That the accelerated declines in the treasury market are occurring in the face of the BOJ defending its yield curve control framework with incremental unscheduled bond buying operations suggests the ultimate high for the 10-year nominal treasury yield in this market cycle could be much higher than we, among the biggest bond bears on global Wall Street this year, imagined. And number three, contributing to investors' decisions to diversify away from the treasury market at a much faster pace were yesterday's JOLTS data. Kevin McCarthy's ouster as Speaker of the House further complicates issues of price discovery in the Treasury market. Any missteps by Congress in the coming weeks risk stripping the U.S. of its lone AAA rating from Moody's and potentially could destabilize markets by further alerting creditors regarding the unsustainable path that U.S. fiscal policy is on. We'll transition to our cross-asset rundown here this morning. We'll start with U.S. equity sector performance. So the S&P down 1.1% on a week-over-week basis, being led sharply to the downside by investors booking some gains here in energy, down 6.7% week-over-week. Utilities continue to suck wind at down almost 6% on a week-over-week basis. You got financials down 3% week-over-week as well. So that's something to be of note. So it's pretty interesting mix of what's leading and lagging here week to date. Not a lot of dispersion from the perspective of the bottom up or top down macro regime. So we'll have to continue to see how this evolves just in terms of what's likely to occur next. In terms of factor performance, we are seeing a decent amount of dispersion and signal here. As I mentioned, the S&P 500 is down 1.1% week over week. You got value getting crushed at minus 2.6% week over week, whereas growth is actually flat here. So this is the market actually moving incrementally in direction of a counter-cyclical bias in terms of getting rid of things like growth or getting rid of things like value in favor of cyclicals. In terms of geographic performance, so S&P still outperforming the rest of the geographies at down 1.1% week over week, leading to the downside. You got Japan, investors booking gains there at minus 6.7% on a week over week basis. You got Brazil down 3.4%. And China down 3.3% as well. So this is something that continues to make sense in the context of our global liquidity monitor. Got some continue to have active systematic shorts on in a number of these geographies and have for several months. Continue shifting to a fixed income performance. You get the core ag down 1.3% week over week, continues to be led to the downside by TLT at off minus 3% on a week over week basis. You also got LQD, that's investment grade corporate credit, down 2.2% week over week. And recall that part of the reason we've seen such a resilient business cycle, among many reasons, is because corporates have termed out their debt from a maturity standpoint. But that's obviously made the entire investment grade corporate credit market much more susceptible to duration risk, which is why it's been trading a lot like treasuries, in recent quarters. In terms of currency market performance, you have the dollar up small, up 0.3% on a week over week basis. It's probably like the 11th or 12th or 13th consecutive week of dollar strength here. It's being led to the downside, the currency market, by the Canadian dollar at minus 2.2%. That's probably in line with what we're seeing in terms of the energy collapses on a week over week basis, in terms of energy stocks, rather. And then commodities transitioning, we got DBC down 4.1% on a week over week basis. You got uranium, which was the star of the ball last week, down 9.2% on a week over week basis. So that's something to be aware of there. You got USO off 6.8% week over week. So that's one of those factors contributing to the decline that we're seeing in energy. It's obviously positive at the margins for broader risk assets. But clearly, this is not going to be too positive in the context of some of the bond market volatility we're continuing to experience, and we've long expected we would experience in this particular market cycle, because we're, in our opinion, not too close enough to a recession to really justify some of that immediate bearish pricing that we saw in the fixed income market. And that's obviously really come out of the curve. And you also seen term premium back up pretty substantially in recent weeks as well. And this is something that we've been flagging for investors all year, which is the very perfect pricing starting point in the bond market in terms of deeply negative term premia, inflation expectations that were perfectly anchored around 2% or really 2.25%. And we flagged both of those things as being very wrong several quarters ago. and clearly this is something that's paid off in terms of helping our clients stay on the right side of this fixed income bloodbath. A lot of folks, don't forget 10-year treasury yields, the 10-year treasury, TLT, not 10-year, 20-year treasury, TLT, that ETF is down almost 22%, down 22% since its December high. A lot of folks, worried about, the 60%, this in terms of the 60-40, in terms of the U.S. economy and recession fears. But folks really, what they missed, obviously, in terms of the 60%, they also missed in terms of the 40%. Because obviously, if you think about, putting on a recession playbook, a lot of folks are just very long bonds this year, and very clearly getting forced out of the trade by Mrs. Market, who is obviously the best teacher of them all. And then lastly, wrapping up crypto performance, Bitcoin up 4.1% week over week. This to me is a stealth signal that a lot of the bond market volatility that we're experiencing in the fixed income market that spilled over into the equity market and credit markets is not necessarily something that may be causing a big significant shift in kind of how markets are likely trading over the medium term. You would definitely be seeing crypto perform poorly in that context if that were the case. It could be on the precipice of changing here, so check back with me tomorrow, obviously. But we got Bitcoin up 4.1% week over week. I got Ethereum up 2% week over week. You also got Cardano up 2.6%, and then crypto is being led higher by Solana week over week at up plus 12.8%. So we'll wrap it up here with my my Lombo dashboard here. Our rundown of global macro from a trading range perspective does not yield any overbought or oversold signals, so nothing to do from a tactical standpoint. I think as I mentioned, reflation, inflation, now time for top-down market regime status. This is a very, very critical week, arguably the most important week since going back to March or April of kind of mid-March of last year or of this year, in terms of like trying to figure out where markets are likely headed from a top-down signaling standpoint. So it behooves you to have a quantitative risk management process that's A, proven, and B, accurate in terms of where the markets might go from here, because we are not at a very inconsequential price level. We're right above the 200-day moving average. And so if we continue to see some adverse quantitative risk management signals, we're going to see an accelerated decline in the S&P that may ultimately lead to a crash. So this is definitely not the time to be playing games here. So definitely be checking back with us in terms of our quantitative risk management signals on a daily basis in terms of our lead-off morning notes. So we'll wrap it up there. Darius Dale presenting our macro minute for Wednesday, October 4th, 2023. Best of luck out there today. We'll catch you back here tomorrow. Cheers.